All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Market rallied nicely into the close yesterday. Saw about a 60-point bounce there into the close as some hopes for oil and what we're seeing with the Saudis and Russians comes in. There's hope for more stimulus measures here in the U.S. And those things help to keep the market from cratering yesterday. In all, on the week, we are looking at a market that's pretty flat. We've had a high here of 26.36, a low of 24.24. You think about that range. That's a 212 point range. That's a massive range on the market this week. Yet compared to other weeks, it is relatively flat. And if we come and take a look at a 1 hour chart and put that in, we can see, this market hasn't gone anywhere, since basically 2 Tuesdays ago, right? And so, yes, still some volatility, still some chop, and still a lot of unknown out there. But the heavy, heavy sell pressure has been gone. We have seen more buy pressure, this week in terms of the volume flows. But the question comes: is it a rest? Is it a pause, or is it simply a sign that bottom is in and off we go? The market internals don't suggest that bottom's in and off we go. Market internals aren't always right, but they tend to be pretty accurate. But still a lot to kind of play out. Still a lot to see happen here. Now, this morning we did get a jobs report here in the U.S. Let me kind of just show you the reaction. The reaction came in at 6:30 my time, and you can see it's not a huge reaction here. Relative to what we have been seeing. It's an ugly number. There's no question about it. There's 700,000 job losses, but let's face it, it's probably more like a few million given what we're seeing in the unemployment claims, but that's not going to be tallied until next month's data. So it does leave investors kind of looking and going, okay, what does this all really mean? And when it comes to the economic data, there is massive economic uncertainty. And I thought I'd bring up the MarketWatch website here and kind of show that to you. Here's the front page of MarketWatch this morning. And let's just come into, let's come in right here. Fitch sees deep global recession just 10 days after predicting slow economic growth. Okay, not exactly, saying a ton. Brace for the deepest recession on record, says analyst at Bank of America as jobless claims surge to 6.6 million. Morgan Stanley releases new forecast showing U.S. economy may drop as much as 38%. This is after yesterday the UN came out and said the global economy may drop 1%. Well, if the U.S. economy is dropping 38%, the global economy sure isn't dropping just 1%. But why do I show this? Not to show who's right, who's wrong, what's all of that. No, just to show the massive uncertainty. These are very intelligent analysts that run very complicated macro models for the global economy, and they vary widely. And so that leaves investors in what type of a place? Well, if the economy is going to drop 1%, then stocks are totally different than if the economy drops 38%. That all said, what does a 1 to 2 quarter drop matter for long-term investors? If it's just a 1 to 2 quarter drop, long-term investors are going to be like, yeah, okay, fine. But if this thing shows that it's going to continue to have legs, that it is going to continue to see People quarantined, staying at home, social distancing, right? All that kind of stuff. Then we're going to continue to see lower economic activity, and the numbers are going to look worse and worse and worse. And recession, depression, whatever you want to call it all, right? Hindsight, we'll see what all the numbers ultimately shape up to be, and then economists will name it. But, it is one where there continues to be massive uncertainty about what the economics are doing. Now you think about individual companies. You look at individual companies and go, okay, what does this mean for them? What does this really mean for Apple? What does it really mean for Starbucks? What does it really mean for American Airlines? Do they have the cash to hold on? You see some analysts come out and say, hey, buy stocks with strong balance sheets. Well, that's all well and good, right? To buy stocks with strong balance sheets, they're going to hold up. But doesn't mean they're not going to get another big round of haircuts. Now, we've talked about the stocks I like and the ones that I think, survive and all of that, and we've gone through all that. But, I did want to bring up this morning that, the economic data remains highly uncertain just from hey, what's the data going to be? And when it is that way, it's even more uncertain what individual companies are going to be. And so it's just one of those where that's the nature of the environment out there. It's one of the reasons why things like the VIX is so high, some of the market chop is so high, and why we look and go, oh, that was a little bit of a rally. Okay, bulls in charge now. Well, no, not really. Not really. There needs to be something a little more game changing, than what we have seen so far. Now, this morning, we're going to see the market led by energy. Energy will be the leader here this morning. U.S. dollar is trading higher, gold trading slightly lower. We know what energy rallies, essentially tend to do in this market. We tend to see, the entirety of the market sell off with the energy rallies. But, in this type of environment, I'm not going to sit here and go, well, because this morning we're seeing energy stocks, blah, 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 the market's going to do X, Y, Z. I just don't think that's realistic, especially as we go into a weekend where coronavirus cases are hitting over 1 million. So we do see more and more cases coming in. The mortality is climbing on it. And, investors are going to be wrestling with what the data looks like again here over the weekend. I do think it's a relative negative that we're starting to hear companies like Apple pushing back store openings, even Starbucks pushing back store openings, to where they get back to normal. And I think we're going to hear a lot more of that. But the more we hear of that, I do think, it's going to be one of those where investors have to look and go, okay, is this just going to last longer than, we really, initially expected? Does that mean that the buy date for stocks is, going to be pushed out 2 months, 3 months, 4 months, and maybe even longer, depending on, how the coronavirus takes its toll. Now, the challenge here, yesterday we had bearish signals on Valero, which was just not tradable, and for good reason. Now, Valero will be interesting this morning. It'll bounce here with oil, with energy stocks. But I would not be surprised to see the bounce get sold into after a morning rally, similar to what we saw yesterday. But the options just aren't playable. We've also seen bear signals on FedEx and UPS. And you think about the energy prices rallying, that takes some of the luster off of these. UPS and FedEx. Now, the FedEx options came into a better area yesterday. Instead of these 110s, instead of trading up around $8.50 to $9, they're now at $6.10, $6.70, so they're a little bit better. I want to see where they sit by the end of the day here. And if we do see that, these options, the implied volatility comes down another 4 to 5 points on them, I will look to to trade the signal that was generated this week, going into the weekend. But I'm not going to do it this morning. With the jobs report and everything else, I still think spreads are just going to be a little too high. If we do get a fresh new signal, I'll jump back on video this morning. But just looking at the pre-market setup, I'm not expecting anything. But at the same time, I can't fully tell just by the pre-market action here. So I'll jump back on video this morning if we have a signal. If not, I'll be back on normal time here this afternoon. We'll take a look at UPS, FedEx. If they are tradable, we'll go after one or both. And then any new signals that are out there, we'll look to react to. It's not all options that are in bad spots, but it is most of them. That are still bad spots from a challenge perspective. But, I'm willing to stretch it a little bit as we talked about yesterday, but not willing to stretch it to the point of paying 40, 50, 60% more than, what I should be paying overall. Thanks for hopping on. Have yourselves a fantastic day, and we'll talk to you this afternoon. Take care.